Good evening. Welcome to Kenya News Update today. I'm your host, and we're diving deep into a critical economic issue affecting millions of Kenyans. For months, there's been cautious optimism about the cost of borrowing. The Central Bank of Kenya has been steadily cutting its benchmark rate, fueling hopes that cheaper loans were finally on the horizon for businesses and individuals struggling with high interest payments. But tonight, a stark warning from leading economists: those hopes are about to be dashed. Kenyans will not enjoy cheaper loans in the coming months. In this 12-minute deep dive, we'll unpack the complex global and local forces converging to keep credit expensive. We'll examine the data, hear from experts on all sides of the debate, and explain what this means for your wallet and the national economy. Let's begin. Our first chapter, the promise of relief. Since January 2025, the Central Bank of Kenya has implemented a series of measured rate cuts. The goal was clear: to stimulate economic activity by making credit more affordable. The benchmark rate dropped from a high of 13.0% in late 2024 to 10.5% by the end of Q1 2026. Commercial banks, though slow to fully pass on these cuts, had begun adjusting their lending rates downward. The average lending rate for personal loans, which stood at 18.2% in December 2024, had inched down to 17.1% by February 2026. For many, this signaled the start of a long-awaited easing cycle. The inflation rate, a key metric watched by the CBK, had also shown significant improvement, cooling from a peak of 9.5% in mid-2025 to within the government's target band of 5.0%, plus or minus 2.5 percentage points, by March 2026. Economists point to this stabilization as the primary reason for the CBK's earlier dovish stance. The data seem to support a continued path of monetary easing. However, Chapter 2 reveals the gathering storm. The optimism is now colliding with harsh global realities. The primary threat: geopolitical instability driving up the price of oil. Kenya is a net importer of crude oil, and fuel costs are a massive input for virtually every sector of the economy. In the last 3 weeks alone, following renewed tensions in the Middle East involving Iran, the global price of Brent crude has surged by over 15%. This single shockwave has immediate and severe implications. Dr. Aisha Mwangi, chief economist at the Nairobi-based think tank Frontier Analytics, explains the direct link. Every $10 increase in the price of a barrel of oil adds approximately 12 to 15 shillings to the pump price of fuel in Kenya. That translates directly into higher transport costs, higher production costs, and ultimately, higher prices for consumers. The central bank's primary mandate is price stability. If they see a sustained oil price shock threatening to reignite inflation, their hands are tied. They must pause or even reverse rate cuts to anchor inflationary expectations. This isn't just theory. Historical data shows a strong correlation. During the oil price spike of 2022, triggered by the Russia-Ukraine war, the CBK was forced into an aggressive hiking cycle, pushing rates up by 3.25 percentage points in just 9 months to combat imported inflation. This brings us to our third chapter, the global chessboard. The Middle East is not the only theater of conflict pressuring the global economy. As reported, the war in Ukraine continues on day 1466, with incidents like the Swedish military jamming a Russian drone near a French aircraft carrier, highlighting the persistent risk of hybrid warfare and broader geopolitical friction. These conflicts create a risk-off environment in global financial markets. Investors seek safety, often pulling capital from emerging markets like Kenya. This can weaken the Kenyan shilling, making imports, including oil, even more expensive. Furthermore, the United States, under President Donald Trump, has maintained a relatively hawkish monetary policy to combat its own domestic inflation. The U.S. Federal Reserve's key interest rate remains elevated at 5.25 to 5.50% as of March 2026. This wide interest rate differential between the U.S. and Kenya makes holding Kenyan assets less attractive, further pressuring the shilling and limiting the CBK's room to cut rates without triggering a currency crisis. It's a delicate balancing act: cut rates to help local borrowers, but risk a falling shilling that makes everyone's cost of living soar. Now, let's visualize the pressure. The Central Bank of Kenya faces a classic policy trilemma. We can illustrate this with 3 competing objectives. On one axis, you have the desire for cheaper credit to spur GDP growth, currently projected at 5.2% for 2026. On another, the imperative to maintain a stable shilling exchange rate, which has been volatile, moving between 142 and 148 shillings against the US dollar in the past quarter. On the third, the legal mandate to keep inflation within the 2.5 to 7.5% target band. Our sources indicate that internal CBK models now show that a further rate cut of 0.5 percentage points in the next Monetary Policy Committee meeting, scheduled for April 10th, could push inflation above the 7.5% ceiling within 2 quarters if oil prices remain at current elevated levels. The data is forcing a recalculation. This leads to Chapter 4, the domestic debate. Not all economists agree on the path forward. We are seeing a vigorous debate unfold. On one side are the inflation hawks, like Dr. Mwangi, who argue that preemptive caution is essential. They point to core inflation, which excludes volatile food and fuel prices, as still being stubbornly high at 6.8%. They warn that letting inflation expectations become unanchored would be a catastrophic policy error, eroding purchasing power and hurting the poor the most. Their recommended course, a pause in the cutting cycle for at least the next 2 MPC meetings, with a commitment to data-dependent future actions. On the other side are the growth advocates. This group, represented by figures like Professor James Omondi of the University of Nairobi's School of Economics, argues that the CBK is over-indexing on external shocks and underestimating the domestic economic slowdown. They cite recent Kenyan National Bureau of Statistics data showing a contraction in private sector credit growth to just 8.1% year-on-year, down from 12.5% a year ago. They argue that thousands of small and medium-sized enterprises are on the brink, unable to service existing debt or invest for expansion. We are sacrificing real economic growth on the altar of hypothetical inflation, Professor Omondi stated in a recent panel discussion. The oil price may retreat. The geopolitical situation may calm. But if we allow our productive sector to atrophy due to a credit crunch, the damage will be long-lasting and far harder to repair than a temporary blip in inflation. This group advocates for at least one more symbolic cut of 0.25 percentage points to signal support for the real economy, even if its direct impact is muted. Then there is the government's perspective, which adds another layer of complexity. Chapter 5, the fiscal equation. The National Treasury, under President William Ruto's administration, is walking a fiscal tightrope. The government is grappling with a substantial public debt burden, estimated at 11.2 trillion shillings, or approximately 68% of GDP. A significant portion of this debt is domestic, held by local banks and pension funds. Higher interest rates make servicing this debt more expensive, crowding out spending on development projects like the Affordable Housing Plan. However, the government also knows that runaway inflation is politically toxic. There is a philosophical dimension here, hinted at in recent commentary about leadership being rich in knowledge but poor in wisdom. The knowledge is in the data streams and economic models. The wisdom, critics argue, is in knowing when to prioritize the immediate suffering of citizens over textbook macroeconomic indicators. The Treasury Cabinet Secretary has recently called for patience and understanding, stating that the government's focus remains on stabilizing the macroeconomic environment as the foundation for sustainable, cheaper credit in the future. This is seen as tacit support for the CBK's likely cautious stance. So, what does this mean for you, the Kenyan seeking a loan? Chapter 6, the borrower's reality. Let's break down the numbers for a typical loan scenario. Suppose you are looking for a 2 million shilling personal loan over a 5-year term to expand your small business. In February 2026, with the average lending rate at 17.1%, your estimated monthly repayment would be approximately 49,700 shillings. If the CBK had been able to cut its rate by another 1.0 percentage point, and banks passed on half of that cut, your rate could have fallen to around 16.6%. Your monthly repayment would then drop to about 48,600 shillings, a saving of 1,100 shillings per month, or 66,000 shillings over the life of the loan. For a family seeking a 5 million shilling mortgage, the numbers are even starker. At a current average mortgage rate of 15.5%, the monthly payment is about 120,400 shillings. A half percentage point reduction could save them nearly 1,500 shillings per month. These are not insignificant sums for household budgets. The economist's warning means these potential savings are now off the table for the foreseeable future. Lending rates are likely to plateau at their current levels, or if the shilling weakens significantly, they could even tick upward. Furthermore, banks are likely to become more risk-averse. With economic uncertainty rising due to global factors, they will tighten their lending standards. This means higher down payment requirements for assets like cars and homes, more stringent documentation, and a preference for lending to only the most creditworthy customers. The credit gap for informal sector operators and micro-entrepreneurs, a persistent challenge in Kenya, is likely to widen. In our final analysis, Chapter 7, The Path Forward, the consensus among a majority of economists we consulted is that the era of anticipating steady rate cuts is over, at least for the next 6 to 9 months. The CBK's next move is almost certainly a hold. The key variable to watch is the oil price. If tensions in the Middle East de-escalate and Brent crude retreats back below $80 per barrel, some room for maneuver could return by late Q3 or Q4 2026. However, if conflicts persist or escalate, the risk shifts from a pause to potential rate hikes. Another critical indicator is the performance of the Kenyan shilling. The CBK has spent significant foreign exchange reserves, estimated at $7.2 billion as of end February, to smooth volatility. A sustained attack on the currency could force their hand. For consumers and businesses, the advice is pragmatic: reset expectations. Do not budget for significantly lower interest expenses in 2026. If you have an existing variable rate loan, factor in the possibility that your payments will not decrease and could increase. For those looking to borrow, shop around aggressively, as dispersion in bank rates may widen, but understand that the baseline cost of credit is stuck. The focus should shift to improving creditworthiness, cleaning up credit reports, consolidating debt, and building savings to qualify for the best possible rates within this high plateau. The hope for cheaper loans is not dead, but it is deferred. It is deferred by wars in distant lands, by the decisions of central bankers in Washington, and by the immutable laws of economics that tie a net importing nation like Kenya to the turbulent tides of the global market. The coming months will test the wisdom of policymakers as they navigate between the knowledge of data and the reality of people's lives. One thing is clear: the path to affordable credit just got much longer and more uncertain. For Kenya News Update today, this has been a deep dive into the economics of hope deferred. Thank you for watching. Subscribe to Kenya News Update today.